we're here tonight to talk about the plague of leaks. And we certainly already all know all about leaks, but isn't it interesting that we happen to choose the night before two torrential days of rain are promised? So I don't wish new leaks on anybody, but after tonight's presentation, you'll probably have a better idea of what you can do legal-wise and insurance-wise as leaks occur. Why is this? This is because Steve and Ed brought this wonderful topic to my attention. Steve is Stephen Lasser, the managing partner at Lasser Law that deals in a wide variety of real estate transactions and endeavors, including lots of services for housing cooperatives and condominiums. And his partner in crime tonight is Ed Mackoul, the CEO of Mackoul Risk Solutions, a family business in the insurance field that has always had a very warm spot for housing co-ops and condominiums. So I'm very pleased to welcome them tonight. They're going to do all the speaking, but I'm going to try to help move questions along. Please put your questions in the chat, and our speakers will pause at various points and we'll put forth those questions. Please try to make them general questions. This is a forum for getting to know these two gentlemen, finding out how to reach them, etc. But it's not the forum for asking very, very building specific questions. So I will try to keep an eye on the chat. We'll put forward your questions. I think that that's all we have to know. So I'm going to turn this over to Stephen and Ed and let them give you the benefit of their knowledge.
Okay, so
thank you
for the introduction, Marianne, and thank you everyone for showing up this evening, especially the people that are on boards that are volunteering their time, not getting paid to be here. And I also wanted to thank Ed for helping host this with me. So Ed, thanks a lot. Marianne already mentioned some of the housekeeping stuff. I just wanted to mention that, please stay on mute. If you can, ask your questions through the chat. We'll try to answer questions as we see them. We want to make this, interactive and helpful to you. We might go off topic a bit in that way. And I think, Ed, there's some things that we're going to cover that are not on the PowerPoint. I'm going to do a share screen in a minute. We have a PowerPoint that's, I think, 20 pages, and that's going to be circulated around later this week or by the end of this week. The other thing I wanted to mention is that we're not providing specific legal or insurance advice. So even if we answer your questions, you should definitely get a more detailed personal response. Don't take what we're saying and apply it necessarily to your situation. I already mentioned the outline, and what we're going to try to cover basically is the different types of insurance, which are basically the buildings policies in a co-op or a condo, the individual unit owners policies, and then you might have a tenant's policy or renter's policy, and also potentially some other policies we might talk about are if there's a commercial tenant. So the commercial tenant's policy has some nuances to it, as well as if there's a contractor involved in a leak, the contractor's insurance might also be triggered. So those are sort of the insurance policies I think that we're going to discuss. And also we're just going to relate them to the building's governing documents. That's going to be more of what I'm going to talk about, is the governing documents, the proprietary lease for a co-op, and the bylaws for a condominium. Second slide. So Ed, I don't know if you want to just talk about generally about the what's detailed in this slide.
All right, so most people are confused as to the responsibility that they have inside the unit. And that is because there's two real areas in the bylaws which dictate different things that are confusing. So if you own a single family home, it's very simple. You're responsible for everything. That pipe under the sink is yours, the damage it causes is yours, the TV that is damaged is yours, everything in there is yours. Well, when you live in a corporate condo, things are different. And so you're dictated by the governing documents. And in the governing documents, there may be two areas. Steve, I'm actually going to go back a couple of pages because I'm seeing in page 4 is highlighted. And so if you can go back 2 pages. So the first is there's typically one area is called maintenance. And maintenance really dictates what the owner is responsible for in the unit because they have sole access to it. So that pipe under this, let's say under the kitchen sink or the bathroom sink, is the responsibility of the owner to maintain because they have sole access to it. Now, there's another section in the bylaws, which is basically known as damage or destruction to or destruction of, and that goes over what the party is responsible for in the event of a covered peril. So let's use that pipe under the sink again. The owner may be responsible for maintaining that pipe, and if it needs to be replaced because of normal wear and tear, they need to replace it. But if that pipe was damaged because of a fire now, the association may actually be responsible for replacing the pipe that was damaged due to a covered claim. So those 2 different areas. Now, to make it matters worse, what causes more confusion is people will think, okay, well, that pipe under the sink is my responsibility as the homeowner to maintain. They think the damage it causes is also their responsibility. Now, that's not necessarily true. And matter of fact, that's not true in most cases. So what I tell people in most cases, it's not what caused the damage, it's what was damaged. And in 95% of the time, that's going to be accurate. So if there is damage to something, usually you're not looking to say, okay, well, what was the trigger that caused the damage? You want to know what was damaged. Okay, so again, inside a unit, you may have different responsibilities. And so let's use a co-op, for example. Most co-ops are written the same way, which basically says that the co-op is responsible for the original condition of the unit, and then the shareholder has any improvements or betterments they or any prior shareholder has made. So if a building that was built in 1920, I may not have upgraded the bathroom and the kitchen, but I'm sure in the last 102 years, it's been upgraded multiple times. So if I want those improvements back, I need to insure them. Steve, if you go to slide 3. Now, let's give an example, and then we'll go into the exceptions. An example would be, let's use the pipe in unit 3J bursts that's under the sink and causes damage to the original floor in unit 3J, which is the co-op's responsibility. It causes damage to the upgraded kitchen in unit 2J, which is the owner's responsibility, and it causes damage to their television as well. It's not what caused the damage. It's not the pipe that dictates responsibility. The bylaws are going to basically say that the owner in 3J that the association is responsible for the original floor in 3J because that's their responsibilities per the bylaws. It's going to say that the improvements are the owner in 2J's responsibility, and the TV is his responsibility because that's his contents coverage. So even though the pipe was 3J's, 3J may actually have no responsibility to make any repairs here. Because again, as per the governing documents, they're not responsible for the original force, the association is, and they're not responsible for improvements that a tenant made or somebody else's contents. Now, what is the exception? Well, there's 2 exceptions, and the main one is negligence. Now, if there's a negligent act that I do that causes damage to, let's say, to my neighbor, Steve, if I'm negligent, well, then my policy and I am responsible for the damage that I cause. So what would be an example of negligence? I'll give you some examples that we've seen in our office, and we've seen them probably more than once. We've seen a child stuff a doll down the toilet and flush it to see a whirlpool, and the toilet overflowed. We have seen instances where there was a gentleman who was watching the football game one time and went to run the bath and forgot that he was running it, and he went back to watch the football game. Eventually, the tub overflowed. We've seen people fall asleep in their bed with lit cigarettes. We have had another common one is the building shuts off the water to do work. A shareholder or owner goes to the bathroom or the kitchen, turns it on. Oh, no water's coming out, and they walk away from the sink, but they forget to turn the sink off. So when the building puts the water back on, the sink eventually overflows. So these are all clear-cut cases of negligence. Now, what wouldn't be considered negligence? Well, definition of negligence is what a prudent person wouldn't do. So sometimes it is tough to understand, and it's tough to clarify what negligence is. I'm going to tell you what isn't negligence as per many, many claims I've seen come into the office and the way it's handled by the insurance companies. A water heater bursting is not considered negligence. Even though the typical life expectancy of a water heater is 10 years, let's say, or 20 years, if it's older than that and it bursts, it's not considered negligence. A washing machine hose bursting, the dishwasher hose bursting, anything related to the ice machine, all of those are not considered maintenance, which sometimes people are hard pressed to believe that, but that isn't considered negligence. And that's the reason why I will say that if a washing machine hose bursts and causes damage, it's not going to be considered negligent. And that's why you go back to not what caused the damage, but what was damaged. And that's the easiest way to go about it. So again, 95% of the time, it's what was damaged. The other 5% of the time, if there was negligence on the part of one of the parties, then we want that party and their insurance company to pay for all of the damage because there's negligence. Another area where there could be an exception are deductible resolutions. You have more and more associations who are amending their governing documents to put more of an onus on the owners. So what they're saying is, okay, well, we're responsible for Marianne's floor in her unit, but if a pipe under her sink bursts and causes damage to her floor, and we're responsible for the repairs, we're certainly not paying for the deductible. She's going to pay for it. So you see more and more associations who are adding these resolutions, which are putting the onus of the deductible back on the affected owners. So if 2 or 3 different owners were all affected, they would all share in the deductible themselves. Okay, so that's another area where it may not necessarily be what caused or what was damaged. The governing documents sometimes will change that.
So one next thing I wanted to just mention, Ed, and let's get another point there, is just the governing documents are typically in a co-op, the proprietary lease, and in the condominium are going to be the bylaws. And also for both of them, for co-ops and condos, you also have house rules. So on the slide that's currently up, it describes 3 ways that an association can be insured, and the insurance will have to also be read in conjunction with the governing documents. So Ed, I don't know if you just want to just run through these 3 scenarios, and then I'm going to run through the governing documents and just sort of give an example of that. All right.
Perfect.
So
most people cover, but that isn't necessarily true, because Steve, can you hear me?
yeah, it's breaking up a
Okay.
little bit, Ed, but
Start
Yeah.
over.
just get.
All right, I got something that popped up saying the internet connection was unstable. All right, so what I was saying is most people will ask, well, what does the insurance policy say it covers? The insurance policy does indicate things it does and doesn't cover, but realistically, in the event of a claim, the insurance policy goes by the governing documents. So the governing documents are going to dictate what is and isn't covered by the insurance policy. And the governing documents are generally listed 3 ways. You will see something, there's 3 known ways: bare walls, all in, and something called single entity, also known as either original specifications or build to spec. So the bare walls and all in only apply to condominiums. Okay, so I'm going to start with bare walls. So in a condominium, 5% of the time, you will see the governing documents will have wording. It won't say bare walls covers most of the time, but the wording will basically say that the association is responsible for putting the structure, the 4 walls, the ceiling, and the roof and the floor back. And the owner has the responsibility of everything inside the unit, including partition walls, cabinets, anything they can really touch. So the association has much less responsibility, and is much more responsibility on the owner. So when obtaining insurance, the owner needs more insurance because they have much more responsibility in the unit. Then you have all-in coverage. Again, only applies to a condominium. All-in coverage is kind of the opposite. All-in basically says the association is responsible for the entire unit. Everything inside that is basically part of the unit, including improvements made by an owner or any prior owner. So basically every improvement they're responsible for. So it puts complete onus on the association and very little on the owner. So the owner only really needs contents coverage in terms of what they need to physically insure because they don't have any responsibility for the improvements. That's probably 5% of the time. The other 90% of the time in a condominium and 100% of the time in a co-op, they're going to have what alludes to single entity or original specifications, which basically says the association is responsible for the original condition of the unit at the time of conveyance, and that the owner has any improvements that they, and as I said before, another prior owner has made as well. So if Marianne bought the unit, made improvements, and I bought the unit from Marianne, I'm responsible for ensuring the improvements she made if I want them back. Okay, and co-ops are written the same way, and there's some differences because in co-ops usually there's more the shareholder has responsibilities such as fixtures and decorations such as paint on the wall or carpeting. But as far as the unit itself, it kind of goes back. If there's no improvement, then the responsibility typically falls on the association, and once there are improvements, that falls on the owner.
Okay, so here are some sample language from a proprietary lease, and this talks about the repairs. You can see in the second paragraph on this page, it says repair of the apartment. It says tenant shareholder should be responsible for all the paint, wall surfaces, plaster, decorating required for the apartment, including the interior windows, etc. So that's the general sort of type of repair provisions, and you'll see in a proprietary lease that the co-op's responsible for the building, the shareholders responsible for the interior of the apartment. Then this continues on talking about, you know, that basically you're responsible for the interior of the apartment. And then the other provision that's sort of relevant to this discussion is you need to not just look at the repair sections, but you need to look at damage to the apartment. And then here it talks about if there's damage that's covered by insurance. And I think this is what Ed was explaining, that if there's insurance, then it's going to potentially kick over to the co-op. And then in some instances, it would be the co-op, and Ed, correct me if I'm wrong here. In some instances, the co-op might be responsible technically, but you might want, if there was negligence involved, there might be an exception in the governing documents, or you might want to see if the shareholders insurance covers it so that you're not putting it through the co-op's policy in the case of negligence. Does that sound correct?
That is absolutely correct. I mean, anytime you can push a claim or transfer the risk to a negligent party, you want to, if someone drives and rear ends you, you have insurance in your car for that. But what happens is now you submit it to your insurance company, it's on record, you have a deductible. And it works the same way here. You typically have insurance for the damages that negligent shareholder or owner may have caused, but we don't want the claim going against the building's insurance company when the owner was negligent. We want their insurance paying for it so that they're picking up the damage. There is no deductible, and that claim isn't on record. Claims are the single biggest reason why insurance premiums increase. So anytime you can transfer the risk, you do so. Steve, I'm just going to jump in here a second because there's a couple of questions. So we have one that is asking, is it considered negligence if a tenant does not properly maintain a bathroom that causes a non-pipe leak? That's kind of, it's general because I don't know what the non-pipe leak would be. So again, negligence is a tough thing to quantify sometimes. So could it be considered negligence? It's very difficult. You'd have to be able to prove that this person knew there was a leak, chose not to address it, and that over the course of time it caused damage. So it is conceivable that it could be negligence, but I got to tell you, leaks could be going on for a long time before anyone realizes they're happening, and it'd be very difficult to consider that to be negligent.
But aren't we talking in this instance of something like an overflowed bathtub? Wouldn't that be a non-pipe?
Well, that absolutely. Right. When they say properly maintained, it's a little bit different. Again, something that's a quick trigger. Insurance is quick and fortuitous. So it's quick trigger, a burst pipe, a hurricane. We know the instances here. So that kind of, when they say does not properly maintain a bathroom, that doesn't sound like to me that an overflow happened because of an incident. It sounds like something that's probably a maintenance issue. And so it's tough for me to answer that.
I can chime in. I asked the question. Sorry, can you hear me okay?
Sure.
Yes.
Okay, yeah. So in a very specific situation, a tenant above had not properly sealed around the bathroom tile and tub area, and it caused a direct leak below. And then in the weeks following, the damage continued after knowing that a leak was active.
So this is grouting and sealing, is that?
It
Yes.
sounds, that's what's exactly what she's asking. And now it's tough because first off, did they do the work themselves? Did they hire someone? So let's start with that. If they did the work themselves, could that maybe be considered negligence if that person knew that the work was faulty and that leaking continued and they chose not to address it? It's possible, but there's a lot of work that is done by contractors or anyone for that matter that isn't always up to par. So this one's a tough call. I'm going to say it's a gray area. It might be difficult to prove that there's negligence there, that they knew that the work was poor and that it was leaking. So it's a tough one.
Gentlemen, do we want to go through the questions that are already in the chat?
Sure, why not?
The first one is, if there's a roof leak and an owner's custom painted walls get ruined, who is responsible in the co-op?
Typically, whether it even custom or not, typically in the co-op, the shareholder is responsible for paint on the walls. It's considered a decoration, especially the fact that it's custom painted walls, they're going to have that responsibility.
I think the shareholder is pretty much always responsible for the interior. But somebody then answered by saying for the roof, their co-op was told that roof leaks are not covered by insurance unless the roof blew off in a storm.
There is some truth to that, because the way most insurance policies work, and I'll say most because it's not all, but most insurance policies require, in order for there to be coverage for the damage to the interior, there first must be damage to either an exterior wall or the roof. So let's say a hurricane comes and rips the roof off, and then we take damage to the interior. Well, they're going to cover the interior because there was first damage to the roof itself. A lot of times what isn't covered is either a roof leak or leaks coming in from the parapet, because there's no damage to the exterior first. It's just pointing work that they consider it a maintenance issue. They need to do pointing work, they need to do roof repair work. So to an extent that's true in most cases, that if there isn't damage to the exterior wall or roof first, there is not going to be coverage for damage to the interior. And that's most of the time. There are some companies that will cover leaks from the outside though.
Then someone is asking, can the co-op require shareholders to name the corporation, board of directors, and managing agent as additional insureds? I assume on their homeowners policy.
Yeah, and let's hold that question because I think we cover that
Okay.
later. So let's just remember to circle back on that. So I just wanted to put up, there's a slide here to show some sample condominium bylaws. We already talked about the co-ops, but here it just the definition of a unit. Usually there'll be a definition of the unit, there'll be a definition of the common elements. Generally, you can think of the unit as the box, from the walls inward, and that's what the unit owner is going to be responsible for. Then you have your, repairs and maintenance provision, basically saying that the unit owner is responsible for the interior of the apartment or condo unit. Then typically the condominium will have an insurance provision, says that the board is responsible for maintaining insurance over the building. And then there's usually a waiver of subrogation provision here, which we're going to talk about a little bit later. And then one thing that I see that's not here, but a lot of times condominiums will also say that there'll be a last paragraph on the insurance section. It'll say that unit owners can get their own insurance, but it can't be in conflict with the condominium's insurance. And I think what we recommend is that you sort of expand on that if you're considering doing an amendment, which we're going to talk about that process in a little bit. But the idea is, mandating insurance for unit owners and for shareholders in a co-op, we think is a good idea, and something that all boards should consider, because that's typically when there are disputes or bigger problems when people are not insured or underinsured. Okay, so the next slide here talks about house rules and regulations. And I just mentioned that that you can amend your governing documents to require owners to have insurance, but that requires a 66 2/3 vote typically in most co-ops and condominiums. So it's not always easy to amend your governing documents to require owners and also renters to get insurance. The other sort of category of governing documents is house rules and regulations. They don't have the sort of same authority as the proprietary lease or the bylaws, because house rules can be created and changed by the boards, by a co-op board or a condo board. And technically, boards are not supposed to create more expansive obligations in certain areas that are already sort of covered specifically by the lease or bylaws. However, I know a lot of boards that do put in house rules pertaining to the maintenance of insurance. And, we encourage boards to do that because, I think the courts could go either way on that as to whether or not a house rule created by a board mandating insurance, if there's nothing specific about that in the lease or bylaws, whether that would be enforceable. But I mean, the idea there is to encourage people to get insurance. And I think you're much better off having that if you can't amend if you can't get the full vote to amend the lease and bylaws. I think putting it in as a house rule is another good mechanism for doing that. Although it'd be better if you had it in the lease or bylaws. And then if you do put in a rule, whether it's through an amendment process or it's through a house rule or rule and regulation, that's something that should be sort of monitored by management. I think Ed, there's another slide about this later, but really it should be monitored by management. It could also be done when someone is new to the building. You want to make sure that they have insurance, and it should be checked on an annual basis to make sure that there aren't lapses. I don't know if you
Steve, I'm
want.
going to jump in here and
Sure.
just it make you look good, and I will tell you why. Because every property manager who's watching this now is saying, "No, Steve, don't say that." It is yes, we do want to get the insurance required. It is very difficult to maintain, and it's time consuming, and it falls back on the managers a lot of times, and they don't like that, which I don't blame them, because it is extra work that it really isn't anticipated in the management contract. So there is, and I'm not pitching us here, but we have come up with, and there's other places that are starting to do it, that is an outside service that will monitor the homeowner's insurance. And it's a better way because it's, again, the property manager who has 100 different things on their plate, adding another one, which is very time consuming. Because let's think about it. Let's say we have 100 units in the building. Well, 100 people, if they all had the same expiration date on their insurance, would probably be relatively easy. You request it once, everybody sends it in, you know who has, who doesn't. Well, with 100 different expiration dates, that's probably 8 a month that are going to renew, which means it's constant. That has to be followed up on, because you have 8 people every month whose insurance is renewing. So it's not a once a year thing. It's a 100-unit building. You're probably going to have to do it 100 times over the course of the year. So I would say just there are places out there that you do. It is a fee to do it, but they are going to do a much better job and a much more thorough job, because that's all they're doing, rather than the property manager who has the charge of doing 100 different things for the building.
Yeah,
So I just wanted to jump in there.
Agree 100%. And someone definitely could be the management company, or you could hire an outside company. Obviously, there'll be a fee involved with that, but someone really should be monitoring that. If you're going to put the policy in place, you want to make sure it's enforced. And then, getting back to, house rules and regulations, that's where, the board has the authority to fine typically. So you could put in a provision, the board could create its own provision that if someone fails to comply with the insurance requirements, that they can get a fine. So that's one way to sort of encourage, participation by shareholders.
Right, there's got to be a bite. There's got to be a bite if they don't comply. So I think it's a great idea.
So the next bullet point on here is alteration agreement. So in proprietary leases and in most condominium governing documents, there's a provision that says that the board has the authority to put some restrictions on unit alterations. So this is like if someone's redoing their kitchen or redoing their bathroom, and the alteration agreement is a contract that serves sort of several purposes. One, there's usually a provision that requires that the contractor have insurance, and that the contractor performing the alteration name the co-op or the condo as an additional insured. And in that way, if there is an accident, the claim would go through the contractor's insurance, not the co-ops or the condos. There's usually a security deposit involved there. So that way, if there are damages caused during the alteration, then you can look to that security deposit. It might offset a deductible, or maybe it would cover the entire claim. And then the other thing I just wanted to mention there with respect to alteration agreements is that they require the unit owner to represent that they're going to notify the person who purchases their unit that they've made alterations, and that they're responsible for the alterations. And then the incoming unit owner should have to sign an acknowledgement as well. Therefore, that takes the responsibility for making those repairs away from the co-op or the condominium, and therefore sort of out of their insurance, potentially. And then one other point about alteration agreements is that you can require owners to replace, if it is the owner's responsibility to maintain the plumbing behind the wall, then you can, typically require them to replace up to the riser, so that, they're not putting in sort of new fixtures, but leaving old antiquated plumbing that's susceptible to leaks behind the wall. So that's a good opportunity to sort of have a policy of getting the plumbing behind the wall, or the electric wiring behind the wall updated at the owner's expense for the privilege of updating their apartment. And it sort of benefits everyone, because it can reduce leaks or reduce fires. Next point here is the impact of uninsured on all parties involved. Ed, I don't know if you want to talk to that. And then the next page is about why we should encourage or require homeowners insurance. I think they tie in together, but you want to discuss that, Ed?
Sure. Thank you, Steve. Just go to the next slide. Well, you had mentioned that every owner should have insurance, and more associations are trying to change their governing documents to provide for it, because everybody benefits. And this slide really just talks about why. As we've already mentioned, confusion. And I could say, they say location. Well, this is confusion. People don't understand what their responsibility is inside the unit. And that goes to the board members, that goes to the owners, that goes to the property managers a lot of the times. So what the insurance does is it fits together like a puzzle piece with the association's insurance. So somebody, they may not be sure of what the responsibility is, but we know that one of the parties is going to have responsibility. For shareholders, when they go to a closing, they're not required to show proof of insurance. They're required to show proof of insurance that the co-op has as a whole, not themselves as a shareholder. So a lot of the times they forget about insurance. I tell the story. My father, who started this business 40 years ago, bought a co-op in the city at one point in the early 90s, and he forgot to get insurance for himself because they didn't think twice about it. Showed up at the closing with a certificate for the association and didn't have insurance. And this is a guy who was writing co-op and condo insurance, who teaches classes, and he didn't have insurance. So it's no wonder that people will forget to get their own insurance. They don't realize what their responsibility is within the unit. They may say, well, I bought the unit this way, I didn't touch anything, it's not my responsibility. Well, we know that's true. That's the improvements are theirs. Regardless of whether they've made them or not, they're responsible. You have instances where an uninsured owner is sued for damages by another owner. And ultimately what happens is the board gets sued, the management firm gets involved, they get dragged into a lawsuit. So just having insurance makes it much more cohesive. Other instances I've seen in cooperatives, shareholders think, well, I'm signing a proprietary lease, I'm a renter. They get a renter's insurance policy, which only has coverage for their contents and the liability, and doesn't have coverage what they're responsible for inside the unit. Okay, so that's another issue. In a condominium, if the condominium does not maintain insurance or improvements, there's a possibility that in the event of a claim that unit isn't going to be put back together and made whole. So in a co-op, it's a little bit different. A shareholder doesn't have insurance. If there's a claim, what's going to happen is the insurance company for the co-op is going to say, okay, well, here's a line item for cabin, the bathroom and the kitchen that's upgraded, they're not going to give you the valuation for an upgraded kitchen or bathroom, but they'll give you like, kind, and quality, which may not be a fraction of what the improvements are, but they'll give you a line item for replacement. Well, in a condominium, I've seen it adjusted both ways. I've seen, depending on the wording in the governing documents, that says that the unit will not be rebuilt. So if the owner doesn't have insurance for what they're responsible for in a unit, they're getting an empty box back, basically. Now try selling that, and you may be able to, but you're certainly not going to get full value for that. And boards are constantly faced with charity decisions when there is inadequate coverage. Oh, I'm sorry, Mrs. Smith, she's so sweet, doesn't have insurance. Let's pay for the damages she has. So, and you can't do that. Once you do something for someone, you don't do it for the next person. Well, guess what? That is now a lawsuit. So that's why every association should at least require, and if not require, then encourage homeowners insurance.
Are you guys ready for a bunch of questions? They fall
I
into
think
two
so.
categories.
Sure.
There are the specific incident questions, and there are the house rules
So
questions.
just one quick point here, though. It says the next slide is how do we maintain coverage? And I mentioned, having someone monitor the coverage, putting in a house rule to find people, and then there was it says here that require renters to have the appropriate policy if there's a sublet. But I think one of the questions previously was about having the association named as an additional insured. I think, Ed, you can talk to that.
Sure.
I think someone asked that question specifically, and it's covered here.
And that relates to, let's see where, can the co-op require shareholders to name the cooperation board of directors and managing agent as additional insured? They can require, but I got to tell you, it's not going to do any good. Most carriers on the homeowner's side will not list the board or the co-op or the managing agent as an additional insured, because it just provides too broad of coverage. So you can require it, but it's going to be impossible for most shareholders to comply with that. So I would not. My suggestion is you put in what's called additional interest. Additional interest doesn't give the association or the management firm any rights to, in the event of any claims, like additional insured does. Additional insured basically means you're an insured. Additional interest, most of the time what people want is they want proof that the policy is being canceled, and being an additional interest is almost being like the mortgage company. So the mortgage company gets notice that the policy is canceling. That's what additional interest will do. So I would put the words additional interest and not additional insured, because you're making it impossible to comply with.
Who does the notification? From whom does the notification come?
If they're an additional interest, they'll come from the insurance company.
There are more house rule types questions.
Okay.
Sure, you try to answer.
I think it's all from the same building, but it's a nice building. Can the house rules mandate insurance and require production of the policy subject to minimum standards? Production of the policy, producing the policy. That's the question. Do you understand it?
Sure. Yeah, I think.
Yeah, I think Steve, you answered that one before. So go ahead.
You can. Yeah, I think for sure they can write. You can write the amendment of the governing documents. Whether it's a lease or the bylaws, or a house rule to be specific that they do have to produce the policy. You want proof of insurance, and notice of cancellation. To Ed's point, like having, instead of being named as an additional insured, having being named as having additional interest, so that you get notification upon cancellation, so you assure continuity and that the policy remains in place.
By
Right.
the way, let's remind everybody that we are going to be able to distribute these nice slides to you. We'll try to have them to you by the end of the week.
Thank
So
you.
take your
Mary,
notes.
and what I was going to say is again, I have an agency that will mandate and do this, and there's other companies that do it. And the reason they're probably a better option is because there's software that these entities will use that will help them follow up before renewal to make sure that nothing is canceled and that coverage is still in effect. So look into it, because again, it's difficult for the property manager, and even some companies may not list you as additional interest, and which means you're not getting correspondence, and somebody needs to be proactive on that.
The service that you're talking about, Ed, it will accommodate a building where the homeowners have their homeowners insurance with a variety of carriers.
Correct. So the way we do it, and I know other companies do it, is they require everything at one point. So let's say over the course of a month, they'll send out multiple emails to the shareholders or the owners saying, supply proof of coverage, and based on whatever the governing document requirements are. So whatever the limits are, they'll say, this is what you're required to supply. And then they document it over 2 or 3 different times over the course of a month. And then once they have proof that everybody has the insurance that meets the limits, they follow up normally over the course of the year to make sure that their policy is renewed. So yes, they maintain, 1, whether you have insurance or not, and 2, whether you're meeting the requirements that the association has.
Good service.
Agreed.
So I don't know if there are other questions, Marianne, or if we should move on.
There's
to
a
the
bunch.
procedures.
There are specific building specific question. Here we go. If a pipe bursts and damages an apartment's cabinets, who's responsible for the damaged cabinets? From what you're saying, it depends if the cabinets were already there at the time shareholder bought the apartment or not. Is that correct?
Well, assuming the same shareholder was saying co-op, then any improved cabinet would be the shareholders. So not just whether they bought it or whether they made it, it could be a prior shareholder could have made it. So if it is an improved cabinet, then yes, it is the shareholder's responsibility. If it is the original cabinet, then it's going to fall under the association.
A cabinet? Like
The
a
original
kiosk?
cabinets in the co-op, yes, are. The thing is, we don't see too many anymore because, listen, old New York City's gotten older, and people, the first thing what do the people do is they change kitchens and bathrooms. So unless it's a new construction or in the last 10 years or so, it's probably improved.
There's more. Let's see. If a roof leaks into an apartment, but the shareholder will not allow the co-op to test the roof above them for the source of the leak, who is responsible for the cost of repairing the current and ongoing damage? This, I think, is a question for Steve, because the co-op really has access, if I'm not mistaken, whenever it needs it for an emergency like this.
Yeah,
Upon notice.
Sure, 100%. Yeah, the co-op's governing documents are going to provide that the co-op's entitled to access. And, in this particular case, I think you can make the argument that, there's a negligence factor here, or that they're contributing to the damage, in which case, the costs or the deductible, or if insurance is triggered, there would be a case to push it back on the shareholder for not being cooperative in allowing access. So, I think you'd have to, view it in a little more detail, but that I think that you could certainly make the argument that it would be the shareholder's responsibility in that particular case.
And finally, when should not finally, there'll be more, I'm sure. When should the co-op invoke its insurance to cover the repairs for which it's responsible? And when should it not bother filing a claim and just pay on its own?
So I think that's a great question. I think we cover that in a couple of slides. So let's just hold that thought for a minute. Okay. So Ed, do you want to talk about the HO6 policy for
Yes. All right, there's basically 5 main coverages in an HO6 policy. An HO6 policy, it's called a unit owner's policy, but it applies to both condominium unit owners and co-op shareholders. So even though it says unit owners policy, or sometimes you may see condominium unit owners policy, it still applies to both. And what it does is it has 5 basic coverages, and most of the time it comes with these coverages, but they may be minimum limits. You may have to increase them. So the first one is dwelling, also known as improvements or betterments or additions and alterations. What that covers what the owner is responsible for within the unit as dictated by the governing documents. So it could be very little in terms of only improvements, or it could be the entire unit, including partition walls. Goes by the governing documents, but that's where it falls under. Then you have the second area, which is contents, and contents pretty much anything you could pick up and walk out of the unit with: TVs, clothing, computers, anything along those lines. I always tell people, and I probably should not use the word never, but it's never the association's responsibility to pay for contents that were damaged. So again, it boils back down to what caused the damage, not what caused the damage, but what was damaged. Well, the association is not responsible for your contents. So in the event that a pipe bursts upstairs, there's a fire in the unit, that's your responsibility to cover your contents. Then you have additional living expenses. And I'll say the same thing here as I say about the contents. If you can't live in your unit due to a covered cause of loss, so let's say there's a fire and you can't live in your unit, it's not the association's responsibility to pay for you to go live elsewhere. A homeowner's policy will have additional living expenses, which will cover the cost for you to sleep elsewhere. If you got to sleep in a hotel for a week, a month, or 6 months, depending on how much coverage you have, they'll pay for you to eat out because you don't have a kitchen to cook. They'll pay for you if you're able to find a temporary apartment. You're going to be out of your unit for 6 to 8 months. It'll pay rent for you to continue to move elsewhere and to live elsewhere. So these additional living expenses are the owner's responsibility and not the association's responsibility.
Right. And I just stuck in here that the statutory warranty of habitability. Before it's sort of Ed's also going to talk about personal liability, but concept to keep in mind is that in a co-op potentially. Because there is a landlord-tenant relationship, a shareholder in some instances may be entitled to a maintenance abatement if their apartment is uninhabitable due to a leak. And I think you got to look on those instances on a case-by-case basis. But the board might have to consider giving a maintenance abatement. But the warranty of habitability does not apply to condominiums, so you don't have to worry about that concept of if a condominium unit owner is asking for a reduction in their common charges because their unit is unusable, generally they're not going to be entitled to that legally.
Let me put in a
Very good.
tiny plug for CNYC's model proprietary lease, where we carefully distinguish between ownership responsibilities and tenant responsibilities. So if there were to be a partial abatement of maintenance, it couldn't be, you can't abate your owner responsibilities. As an owner of shares in the co-op, you're still responsible for your share of the mortgage and your share of paying staff, etc. So it's an interesting concept that I think is gaining popularity, to carefully distinguish between the two.
It's a good point. Interesting for sure.
That is. All right. And it's personal liability. The personal liability covers a couple of different areas. One, inside a unit, if someone trips and falls, with the owner's responsibility, not the association. It'll also cover the negligence that we talked about earlier. So if I fall asleep with a lit cigarette and burn down somebody's apartment, well, this is where the liability is going to fall under, and where they're going to pay for the coverages out of. So it covers there. And liability is very broad. It's worldwide. So I could be in the park, and I've seen instances where a kid swinging a baseball bat has hit somebody and they sue. Dog bites, this is where it falls under, as long as the dog isn't excluded, falls under the personal liability section. Now, there's one other covers, and I think we moved it, but it's called the loss assessment. And
Yeah, that's actually right here. So there we go.
All right, so then you have a loss assessment. Loss assessment, in the event that the association does not maintain adequate coverage, or if they have a high deductible, the association can choose to assess the owners. So, and the owner's insurance policy will actually cover them for the assessment as long as it's a covered cause of loss. So let's use something like wind or hurricane, for example. If the building has a high deductible, and let's say they have a $50,000 deductible and they have 50 units in there, they can assess the owners for a wind loss to make up for that $50,000. Well, if they do that, then every one of those 50 unit owners would have $1,000 assessment. They could submit their insurance company, which would pay for it. So as long as it's a covered peril under the homeowner's policy, any assessment related to insurance would be covered under the policy.
So Ed, I have a question for you. So on the HO6, are these the loss assessment? Is that a pretty standard provision, or is that like an add-on?
Most companies do include it. They only include $1,000, and it isn't a whole lot to increase to 10,000 or even 50,000. But most will include $1,000 as a base.
Right. Okay. So moving on, the next couple of slides just deal with waiver of subrogation. We're not going to really get into that in great detail, but it's just the concept that insurance carrier can subrogate a claim, which means that they'll step into the shoes of the person that was damaged, and then they'll sue. If there's negligence involved, then they would then sue. They'd take over the claim of the person that was damaged and then sue the person that caused the damages. And typically, policies in the governing documents will say, the bylaws or the lease will have a waiver of subrogation paragraph, so that and that'll sort of mesh with the insurance policy, which the insurance policy will say if there's a waiver of subrogation, then we're not going to go after the person that caused the negligence, and most bylaws are written that way and governing documents. So you don't see subrogation that often. I think maybe you see that more with a contractor. Ed, I don't know what's your experience.
You're 100% dead on with that. And that's why a lot of the times when there is an owner who is negligent, I tell the association, don't rush to put that claim in. I mean, the good thing about the insurance policy is they don't say a specific time. You have 7 days, 24 hours to put a claim in. It says in a reasonable period of time. So if an owner is responsible for damage because of their negligence, I always want the owner to put their insurance company on notice first and see if they will adjust it and pay for the loss. Because once we put it to the association's insurance company, like you said, there's waiver of subrogation. So the association is going to pay the claim because legally that's their insurance policy covers it, but then they can't subrogate and recuperate that money back from the owner and their insurance company because of the waiver of subrogation. So, and I think there was a claim earlier about submitting claims when they should and shouldn't, and that's part of it here. In the instance where it's clear-cut case of negligence, and again, negligence isn't easy to define. So what you may think is negligence may not be considered negligence, but if it is clear-cut negligence, I would ask that we put the owner's insurance company on notice first and see if they're going to adjust it and pay it. And then if they're choosing not to, if it looks like they're heading that direction, we could put the insurance in.
Okay, so then the next slide, we have wear and tear and notification to carrier. So we can talk more about the notification to carrier again in a second, but I don't just want to hit on the point of wear and tear, Ed.
I will. Thank you, Steve. Wear and tear, wear and tear is a typical exclusion in all insurance policies. So yes, there's sometimes confusion because wear and tear is excluded. So what does that mean? Well, that pipe that burst probably burst because it is old and it's normal wear and tear. So the insurance company will not pay for the pipe that was burst because it was normal wear and tear, and it's your job to maintain it. But it will pay for the damage that covered it. A burst pipe is the single biggest insurance claim that the insurance companies have on the property side. So just because a pipe is burst because of normal wear and tear does not mean the damage that it causes isn't covered. It just means the pipe itself isn't covered.
All right, so I think there's that question about the notification to carrier. So Ed, I think, I always thought that, premiums were based on loss runs, and that there was really no harm in notifying the carrier because you're worried about, and from my perspective, I feel like the carriers are always trying to not give coverage let's say when the co-op or the condo wants to get the coverage. So I'm always an advocate of providing notice, but I think the market has changed, and I think maybe this would be a good time to speak to that. And I think you said that the market's really difficult, and that even if you don't have a claim or a loss, just notifying the carrier could potentially affect your premiums, right?
It can. So it's a tough call, and I'll tell you why. Because there are instances. There's liability and then there's property. Let's use liability first. If someone slips and falls outside, picks himself up and walks away, and you don't have any information, you don't know who they are, there's really nothing you can put in. Okay, because the insurance company doesn't have the opportunity to call the person, find out injuries, things like that. Now let's use an example. A person falls, is a shareholder who we know walks out, slips on the steps, gets up, says, "I'm fine, don't worry about it," and then walks away. Technically, that claim should be put into an insurance company, because although they're fine now, they can come back 18 months from now and sue, saying, "Well, my back hurts. I've been going to a chiropractor for a year and a half now." And so you knew that there was a possibility of a claim and you didn't put that in. The insurance company can actually deny that one for late reporting. So on the liability side, what I always tell everybody, if someone saw that person slip, they know who they are, or the person it came inside, said, "I fell outside, I'm okay," you have their information, you got to put it in, because once you're aware of something, you have that responsibility of giving it to the insurance company. Now let's use the property side. I talked earlier about you don't have to report the claim within a specific period of time. But if you choose, a lot of the times the deductible could be one of the deciding factors. If you got a $5,000 deductible and a $6,000 claim, it may not make sense to inform the insurance company, because yes, they're going to pay you $1,000, but two things will happen. One, the claim is on record now. And so for $1,000, it's probably going to cost you more in insurance premiums in the long run when they increase the premium. But two, you want keep as many claims off as possible, because even though it's only $1,000 claim, if the insurance company keeps seeing the same claim over and over, it raises a red flag. So I always tell people it's not that one large claim that gets in trouble. It's the 5 smaller claims, because the insurance company sees repetition and they see we got a problem. We've had 5 burst pipes, even though we haven't paid anything out. There's probably going to be a large payout eventually. So you want to try and keep as many claims off record as possible. Now, that being said, it is a touchy situation when it comes to water, because in New York, an insurance company cannot deny a mold claim as long as the mold has resulted from a covered cause of loss. So let's say a pipe burst, we report that claim, and eventually mold results, they'll cover the remediation of the mold, they'll cover a mold lawsuit. But if a claim hasn't been put in, they could deny the claim because it hasn't been attributed to a covered cause of loss. So if we had a burst pipe, we fixed all the damages, and then 3 months later, all of a sudden there's mold, they're not going to remediate it, and they're probably not going to cover the lawsuit either, because it wasn't attributed to a covered cause of loss because we didn't report that covered cause of loss. So it's tough to tell you not to report smaller water damage claims, because sometimes if it's not cleaned up properly, it could turn to mold, and you won't have your coverage for mold then if it hasn't been previously reported. So it's kind of a catch-22. You want to keep as many claims off as possible, but there may be instances where you have to report them. And yes, the insurance company, right now we're in what's called the hard market. So insurance companies are not looking to write business. As funny as that sounds, they are looking to write profitable business. So they're charging higher rates, and they're turning away more business than they're writing, which is the opposite of a soft market. In a soft market, insurance companies are basically slitting each other's throats to get the insurance premium, because they're taking it and they're making money on investment income, and they want as much premium as possible. Right now, we're in a hard market. In the hard market, what they do is they look at the losses, and they're very critical. So if they see 2 water damage claims in a 2-year period, they may say, no, we're not interested in providing you a quote. So it's a very difficult situation. It isn't clear cut. I can't tell you in every instance this is the way it should be handled, because depending on the market, depending on the insurance carrier, they could hold it against you, or they could say, well, there's no issues here.
And what about just generally, like I know you're saying it's a hard market, but what kind of like increases are you seeing at, like, what's the trend lately?
Oof, astronomical is the right word. A lot over the last 2 to 3 years, there's been a lot of hits because of just insurance rates going up as a whole. But part of the problem is commercial umbrellas are really the issue these days, because people are used to having these $100 million umbrellas that will cost them $2,000, and now they're getting $5 million for $15,000. So it depends on the risk. So if the loss history is good, it may not be bad. If there are a lot of the insurance companies now are looking at the building department to check out HPD violations. A lot of HPD violations, it's a problem. Bunch of different factors that are factoring in now. I tell everybody at a minimum, you should still be putting in 10% of your budget at a minimum, and there's a good chance it's going to be a lot more. And I don't see that stopping next year, because over the last 2 or 3 years, it's really been liability based of why premiums have been going up, because especially in New York, more and more claims are exceeding the $1 million limit provided by the underlying carriers and going into the umbrellas. But now the property is going to start catching up as well because of inflation, supply chain issues, and a host of other reasons, including many, many natural disasters. We're going to see more property insurance rate increases next year. So I would say at a minimum, budget for 10%. Talk to your broker if you have some hair on the risk. And what that means is, again, claims, electric, like stair block circuit breakers. We have HPD violations. I would budget a lot more, because you're probably going to see more than 10%.
Thanks. So then the last slide here, before the closing credits, are just the 2 examples. So I don't know if there were other, Marianne, if there are other.
I think we did all the questions in the
Okay.
chat.
Sure. So we had mentioned in the flyer for this program, the example here of a rainstorm, contractor didn't protect the roof appropriately, water damage to several apartments in the common areas. How does the board proceed? What insurance would be invoked? So I think this is a good example where it's really important, if there's a contractor doing work at the building, to make sure that they have appropriate insurance, and make sure that the building gets named as an additional insured, so that you can put claims through the contractor's insurance, and it won't affect the building's insurance. So that would be sort of the first sort of line of defense here is making sure that you have a proper contract with the contractor that provides for you to be covered under their insurance. And there's a whole sort of side conversation we could have about claims by people injured on the job with from falls not related to leaks, but that could be a whole topic unto itself. But it's very important to get to vet your contractors and make sure that that you properly protect your condo or your co-op from claims stemming from contractor negligence. And then in this case, Ed, I think if there was, let's say that the contractor's insurance wasn't in play, it would go back to I think the sort of what you've been saying all along is that what's damaged. If it's a common area, it's generally going to be the building's insurance, and if it's something within an apartment, it'd be the owner's insurance. And then also you could have another layer of complication here. You could have a tenant, a subtenant, and then they would have their own insurance to cover their losses as a renter.
Wouldn't the renters and the shareholders insurance try to sue the contractor or try to sue the party that caused the damage? Or
they could. I mean, in my experience, a lot of times, depending on the extent of the damage, sometimes it's just not worth it for the carriers to sort of go after the contractors. I don't know, Ed, what's your experience?
You know what? It all depends. In situations like this, is probably a decent sized claim, and that's the reason why you have the contract as insurance. And like you said, Steve, we get the right documents to make sure that we are covered by their insurance. Because again, you want to transfer the risk. So in this case, I would certainly want the contractor's insurance to step up. They do have liability. Part of that is also products completed operations, which covers defective job or faulty workmanship. And that's where that would fall under. So we want the contractor to pay all the damages, including to a shareholder or a renter, because again, clear case of negligence here. Liability is the responsibility of the contractor here. We want it going under their insurance.
And then the second hypothetical you have here is if a hose comes loose on a dishwasher on the third floor, creates water damage in the apartment below and the ground floor commercial space, how would the board proceed? I'll just say, something at the outset here is that if there are sort of recurring sort of maintenance related issues, it's a good idea to sort of mandate, like, for example, if you know that dishwasher hoses, or if they're like the originals in the building and you're sort of seeing them come to their life expectancy, you should start mandating the shareholder or the unit owner to replace those, just to sort of cut down on the on leaks, just from a practical standpoint. But Ed, do you want to talk about the interplay of the insurance here, how you think it would play out?
It's going to go back to pretty much what I said earlier. It's not what caused the damage, what was damaged. Hose coming loose on a dishwasher is not going to be considered negligence. So if the damage was to something you're responsible for paying, then it's got to go to your insurance. So it could be a couple of different, could be the building's insurance paying for the portion, could be a shareholder or an owner paying for their portion. It could be the commercial space paying for their portion. All depends on the documents.
Right.
what about radiator leaks, gentlemen?
Same thing. I mean, the answer holds true. It's not, the radiator leak isn't the trigger. We understand that the radiator leak, but it's not what's causing the damage, because there's no negligence here. It's what was damaged. So what did the radiator leak cause damage to? And that's what you got to go by. TV owners, improvements owners, original floor, walls, ceiling, probably the association.
Oh, and this is a follow-up question. It's nice to have a follow-up question in one short webinar. Why can you require being named as an additional insured on a contractor's policy, but not a shareholder with his or her carrier?
It's commercial policy, and a commercial policy typically understands that there's going to be a relationship that the risk needs to be transferred. So a contractor being hired could in fact cause damage or injury to someone, which would involve the association being named. So on a commercial policy, there's no issues with a contractor. Just like if you have a commercial space in your building, it's generally not an issue for them to name the association as additional insured. This just really falls into the homeowner side. With a homeowner's policy, providing additional insured coverage just makes it too broad, in which case they could end up, the homeowners company could end up paying for a claim that's not their responsibility because it involves the association being an additional insured.
Thank you.
Thank
So-
you.
That's the end of our PowerPoint here. If there aren't any other questions, I guess we just want to thank everyone for participating, asking questions, CNYC for hosting, everyone here for sharing their time and volunteering, and Ed, thanks for being a great panelist. Appreciate it.
You too, buddy. This is wonderful. Thank you. Marianne, thank you so much.
Yeah, everyone, happy
My
holidays.
pleasure. Happy holidays to
all right.
everyone. And within a few days, everyone on this call whose email I have will get a copy of these nice slides.
Great. All
Okay.
right.
Thank you so
Thanks.
much, Marianne.
Be well.
Oh, lots of thank yous in the chat.
Yeah.
So take a look, guys.
Okay, we will. Thanks.
Bye-bye. Thanks very
All right.
much,
Bye,
everyone.
everyone.
Bye.